Welcome back to the Halftime Report. Now for the calls of the day, we are tracking the payments and financials space. First up, you've got PayPal getting a rare upgrade to outperform today. It's been a big underperformer. The analysts over at Daiwa say that there are a number of positive catalysts falling into place for PayPal. Those shares have been crushed over the last year, but they're up nearly 40% since last month. And Jason, PayPal is a name that you own. Do you agree? Is PayPal one of those reasons? Is one of the reasons why this catalyst? And by the way, they specifically mention the increased stake by activist investor Elliott Management in PayPal as well.
Yeah, no doubt about it, Dom. Obviously, PayPal has really struggled this year, down 46%, as you mentioned, year to date. But I think the Elliott play is a really nice play. Obviously, the street likes it. They've got a really good reputation in the space. I think on the cost reduction piece, I think they'll really help there. I think also the buyback, $15 billion buyback that was announced, and also, an investor day that they're going to have. And I think also, when you're looking at the management team, they hired a new CFO, which I think could be positive and a catalyst for the stock. So I like it here. I mean, it's gotten really beat up, so I think there's an opportunity. The multiple has also come in dramatically, trading at about 26 times forward.
Okay, so that's the PayPal story. Jim Lebenthal, this analyst over at Daiwa, is also downgrading both Visa and MasterCard to neutral ratings. He cites reduced earnings upside for those credit card processing companies. Jim, Visa is a name that you own. So is this Visa call something that you're worried about?
Not particularly worried about this part of the call. I'm on the other side of the fence here because we see that international travel is picking up over the past few months as travel restrictions have eased. And the biggest element of growth for Visa and MasterCard over the next year is likely to be cross-border transactions. That's what's frankly held them back in the year and a half up till now. So I'm on the other side of the fence here.
All right, so that's the Visa trade. Our next call on the financials comes from a more traditional one. It's Wells Fargo. Deutsche Bank reiterates it as a top pick and says that it's better capitalized than its banking peers. It's cutting costs. It's more levered to rising interest rates. Stephanie, this is a name that you own.
I totally agree with this call. And he's also saying that the asset cap is going to get lifted sometime in the spring of 2023. That would be a huge positive. I have no insight about the asset cap, but I'm hopeful he's right. But it is a turnaround story. It's a cost-cutting story, right? It's a new CEO who's not even new anymore. He's been there about 3 years. But he's doing a good job. It takes a long time for these turnarounds to start to really work themselves. And at 1.1 times book, 1.3 times tangible book, that's pretty cheap.
So if, Josh, you look at the fintech names, which we focused on for the calls of the day, and then one traditional bank, financials, a place that you want to be, a value-oriented trade that is yet to kind of really come to fruition?
I think the banks could be okay. Look, if you're going to have a soft landing and you're going to eventually get a steepening of the yield curve, or at least a de-inversion of the yield curve, these stocks will immediately feel the effects. The market will get ahead of the fundamentals and they'll run these things up. So I think in that scenario, it's okay. However, there are other scenarios that could play out, and I don't think that these stocks are as cheap as they used to be. They've had a decent couple of years relative to the market and in absolute terms. There are probably some special situations like Wells Fargo that have their own individual catalyst. But to just blanket say, I want to be long financials or fintech, I'm not sure that I can get excited about that particular idea.
Before we let you go, just really quickly, is it, if you're going to go into the banks, is it the money center banks like B of A, JP Morgan, Citi, or is it more the regional banks as a play on interest rates steepening at some point for the yield curve?
Well, if you think the consumer, particularly the bottom half of consumers, are very susceptible right now, which I do, then you have to believe that the larger banks, the money center banks, are going to better weather the storm. They have bigger dividends. They can buy back more stock than the regionals. They should have a little bit more investor support if the market gets rocky. So my answer would be yes. I own JP Morgan. I think it's the bank to own if things get tough. And the chairman and CEO of the bank thinks that things can get tough here. So they're already preparing for it.